Salary or dividends. Most BC business owners think this choice saves them thousands in tax. It doesn't. The tax comes out almost identical. The system was built that way on purpose. But there is a $9,293 difference hiding in this decision. And depending on your situation, it's either a pure cost or the best money you'll spend all year. I'll show you the real math, the hidden line, and how to actually decide. Starting with the math. Say your corporation just finished the year with $100,000 in profit and you want it in your pocket. Route 1. Salary. The corporation pays you $100,000. That salary is a deductible expense, so the corporation pays zero corporate tax on it. All the tax happens on your personal return at your marginal rate. Route 2. Dividends. The corporation pays tax first, 11% in BC at the small business rate. That leaves $89,000 to pay out as a dividend. Now here's the part almost nobody understands. On your personal return, you don't report $89,000. You report it grossed up by 15%, $102,350. Why? Because CRA pretends you earned what the corporation earned before its tax. Then it hands you a dividend tax credit to give you back roughly what the corporation already paid. This whole machine has a name, integration, and it's built so that at the end of both routes, total tax, corporate plus personal, lands within about 1 to 2% either way. So if anyone tells you dividends are the secret tax hack, the Income Tax Act was literally engineered to make that not true. But wait, if the tax is basically equal, why do accountants still argue about this at every year-end meeting? Because income tax isn't the whole bill. Remember that $9,293? It only exists on one of these two routes. When you pay yourself salary, you trigger the Canada Pension Plan. Twice. You pay the employee side, your corporation pays the employer side, and you own the corporation, so really, you're paying both. In 2026, the numbers look like this: 5.95% on earnings up to $74,600, plus the newer second layer, CPP2, another 4% on earnings between $74,600 and $85,000. Max it out on both sides, employee and employer, and the total is $9,292.90. Dividends trigger none of this, zero CPP. So dividends win, right? Not so fast. That $9,293 isn't a tax. It's buying you something, a government-guaranteed inflation-indexed pension for life. Skip CPP for 20 years and you'll have a bigger corporate account, but a much smaller safety net. That's not automatically a win. It's a trade. And CPP isn't the only thing dividends quietly cost you. Salary creates RRSP room. Dividends create none. The formula: 18% of last year's earned income up to $33,810 for 2026. Dividends are not earned income. A shareholder who's taken dividends only for a decade has zero new RRSP room. 10 years of tax-sheltered compounding, gone. Add the smaller items. Salary smooths your income for mortgage applications, and it's cleaner for lenders, while dividends skip payroll paperwork entirely. No source deductions, no payroll account, one T5 a year. And one warning before the verdict: if you're thinking of paying dividends to a spouse who doesn't work in the business, that's TOSI territory. Tax on split income, top-rate tax. That's a whole video of its own. So here's the honest decision framework, because there is no universal answer. Lean salary if you want CPP building, you want RRSP room, and you want smooth, verifiable income. Lean dividends if you already have retirement assets, you value flexibility, and you want minimal payroll admin. And what do most of my actual clients end up doing? A mix. Salary up to a target, often around the CPP ceiling. Dividends on top. The right split depends on your age, your mortgage, your spouse's income, and what's already in your RRSP. This is exactly the conversation to have with your accountant before December, not at tax time. If this was useful, the next video covers CRA audit triggers, the patterns that quietly move a small corporation to the top of the review pile. And a few of them look like smart tax planning, until they're not.